as you can see from this paper, basically I'm trying to study how the climate shocks can transfer across border by looking at the international bank flows. And when I say climate shocks, actually you can think about it, it's just like a hurricane or flood happened within one country and have some damages to your house. For example, in 2005, Hurricane Katrina wiped out the southern coast of America's several states there, and a lot of people lost their houses. They cannot pay back their mortgages, and the bank suffers a loss. So there already paper document that when that extreme weather event happens, banks will decrease their domestic bank lending. And this paper is trying to document that not only bank will decrease their domestic bank lending, they will also decrease their international bank lending. So this is a graph. Actually, the first presenter actually shows this, and he quickly jumped this. So maybe I will take 1 minute to explain it. This picture was took from NASA and shows the temperature anomalies since 1890. So until now, and this picture is benchmarked to the 1980s. You can see a clearly upward trend in the abnormal temperature in the United States. And also, if you're looking at the CO2 emission, you can also find, even after you taking out the seasonal cycle, you still find the upward trend. And this is a rise in the sea level. So among all the scientific evidence that climate change is really happening, and what economists have done with it is actually there are already some works. For example, climate change will affect agricultural outputs, will affect electricity consumptions, also mortality rates and immigrations, etc., etc. And there is a growing literature in climate finance. I think it's especially after 2016, the call for paper for RFS. There are some very great papers. For example, those papers are looking at how the climate change will affect housing price, especially the house located near the coast. Also, the climate risk will affect borrowing cost. For example, these two papers, this one of mine paper, so I have to do a little bit promote for myself. This paper is documenting that when firms announce their green bond issuance, stock market will have a positive or normal return. And also David's paper, I'm not sure he's in this session, so he documented that there is a green premium actually when firm issue a green bond rather than a normal corporate bond. Also, there are papers documenting that climate change will affect the bond price, affect the loan spread, and also affect like mortgage markets. Climate change will also affect news media's and institutional investors' beliefs. So this is a very good survey paper by Philip, Zach, and Laura. So this paper basically documenting that institutional investors pay more attention and they gain more awareness, especially in the recent years. The last paper, I think Professor Zhang will talk about later, so I'll just quickly jump. So what we do in this paper, so basically we provide evidence that local climate shocks can transmit it through the banking network such that generate a contagion effect to the foreign countries, even though the foreign countries doesn't experience climate shocks. So specifically, we examine the bank's liquidity shocks caused by the climate change and focus on its consequences for cross-country bank lending. So I'm using the BIS data across 128 countries. And so we basically confirm that there is a spillover effect of climate risk such that banks will transfer the credit supply fluctuations due to the local climate shocks onto the foreign countries, even when there is no climate-related events happens. So there are two hypotheses. Basically, banks will reduce their cross-border lending when their home country faces higher climate risk. Also, I found that this effect of contagion effects will be more pronounced if the source countries more rely on banking financing. And there are some mitigation effects. So that's why I separate these two slides. I find that the contingent effects is mitigated if banks have a stronger lending relationship with the foreign countries. Basically, the banks will not cut their lendings universally. So they will choose some countries that I have better relationships so that I will not cut lending that much, and I will cut lending to other countries that with a less strong relationship with me. Also, I find banks will reduce the cross-border lending less if the bank capital adequacy ratio is high, and also if the insurance market is more complete. So let me briefly summarize the results. So basically, I'm documenting this effect, and the results holds both in the short-term climate risk measures, which is like extreme weather events happens, and also the long-term climate risk measures. So in the economic literature, people are using like temperature and the precipitations as a proxy for climate change. Also, I use macro level syndicated loan data to apply to use the Hurricane Katrina as a shock and compare that the banks located in the hurricane area, those are the banks are the treatment groups, and the control groups are basically, they don't have branches or subsidiaries located in those areas. And I find that only the treatment or only the affected banks will decrease their cross-border syndicated lending after the Hurricane Katrina. So also I find the mitigation effects, I will just quickly jump through. I will talk about the methodology here. So I think climate risk, or if you treat climate shock as the explanatory variable, is one of the most variables have less endogeneity concern, I would say. So this is just run a panel regressions. I use the changing in the bank flows, log in the change of bank flows in the next year, and regress that on source countries' climate risk and recipient countries' climate risk, and control for a whole bunch of fixed effects and country level control variables, including like GDP, population, TFP, employment, etc. And then I control for, the more importantly, I can control for the country pair fixed effect to really pin down the effect that even within a country pair, the variation is coming through like US lend to African countries, and this relationship will be affected by these climate shocks. So how to define climate shocks? The way we define it, although we are using the different data sets, but the way they construct it is very similar. So basically, a data set called German Watch, they are gathering all kinds of informations around the world, including hurricanes, including extreme temperatures, and they will measure the cost of each event. How they do it? Basically, they find the storms like heat waves, floods, and then measure and also using like social economic data to measure like how much dollar loss of each events in each country, and what's the death of those extreme events. And using that as an index, they will rank the countries and give a score for each country at each year. And this is the short-term, the previous one, the climate risk measure is the short-term climate risk. And the long-term, I follow the econ literature. Basically, they are taking the temperature and precipitations and then mapping those temperatures into the maps and weight by the populations within the country. So this is also a country year panel. And the bank flow data I got from BIS, they provide 26 primary OECD countries to 128 recipient countries. So the way they calculate the number is they calculate the foreign claims based on the domestic bank head office report. And those reports are used by banks in their internal risk management system, so it's very reliable. And also they they will do a consolidation, so we don't have to worry about the inter-office transactions. And those flows not only include equities, but also include like loans, debts, all kinds of fixed income securities. So this is like the baseline regression. I'm not sure if you can see from the back. Basically, the variable of interest is the climate risk. And you can find that if there is a higher in climate risk, there will be a decreasing in banking outflow by 9.1 to 9% in the next year. So I could use other measures like deaths related to the extreme events or the loss in the GDP. So this is a gravity model. Basically, this model controls for the recipient country's climate risk, but also the source country's climate risk. And I find that only the source country climate risk matters. So this is using the long-term climate risk measures, the temperature and the precipitations. I mean the abnormal temperature and abnormal precipitations. So increasing temperature basically means the climate change is getting worse. And I find that the increasing temperature will be associated with the decreasing in bank flows. Then I used the Hurricane Katrina as a shock. And I find that I used the Hurricane Katrina and the subsequent two shocks in the US Gulf Coast. Then I find I use a diff and diff estimation, estimate the period 3 years before and after the shocks. So this is basically the regressions. And I found that the banks located in the Gulf areas will decrease their international syndicated loans by 1.4% to 1.2% in the next 3 years, compared with the previous 3 years. So this regression, I basically interact the banking reliance. So some countries, they are more rely on banking sector financing rather than like capital markets. For example, in China, we don't have a very good equity markets, so we are more reliant on the banking sector. If a country more rely on banking sector, then their loss will be huge when the climate shocks hit the private sectors. So I find that actually if a country more rely on banking sector financing, the effect will be more pronounced. Okay, and then there are 3 mitigation effects I found. For example, the banks will cut lendings to countries with less stronger relationship, and then also due to some regional regulations, banks will reserve some cash just in response to extreme events happens or high probability of liquidity shocks. In particular, I find that banks with a higher capital adequacy ratios have higher risk buffers so that they can absorb more severe climate shocks such that they will have less effects for these contingent climate shocks. And also insurance markets play a very important role when you think about climate change because if domestic insurance market is very complete, households can do risk sharing with the insurance market, and the insurance market will pay back their loans or mortgages instead, so the banks will suffer less. And this is what we found in the data. So the banking relationship is, so the higher climate risk, the bank will decrease the outflows. However, if you have better relationship with the banks, the results will be mitigated. And also, if you have higher capital adequacy ratio here in the second rows here, the results will also be mitigated. The last one is if the home country insurance level is high, the climate risk contingent effect will be less. So let me quick conclude here. This paper examines the transmission of climate risk across countries due to the international bank flows. So I find robust evidence that source country will substantially lend less to the recipient countries when source countries receive climate shocks. I also explored US setting, that's the Hurricane Katrina setting, and find that the similar results. Also, the effects will be mitigated if the country have higher capital adequacy ratio, and also there is sufficient coverage from the insurance markets. And therefore, we may need more collaborations in dealing with climate change. And that's all. Thank you.